everyone, and welcome to Talking Legal with Templars. My name is Damilola Oshodi, an associate in the Energy and Project Practice Group. You're welcome to our first cross-border episode. Today I have here with me Arun Velusami. Arun is a partner in Hogan Lovells in the Infrastructure, Energy, Resources and Projects Practice Group. Interestingly, Arun is also the co-head of the Africa practice. His experience includes advising governments, project sponsors, project developers, and lenders on a variety of energy projects with a particular focus on power projects in Africa. So welcome, Aaron, and thank you for joining us.
Thank you, Danny. It's my pleasure to be here.
Thank you. So today we're going to be talking about risk allocation in public sector power projects with a focus on Africa. Before we deep dive into today's topic, I wanted to hear from you, Aaron, why you think this is an important thing that we should be talking about in the current business climate in Africa and particularly Nigeria.
Well, I think shortages of power have been endemic throughout Africa for the last 20, 30 years. And there's one statistic that's commonly cited that the entire power generating capacity of sub-Saharan Africa is approximately the same as that of Spain. And the population of Spain is around 45 million, whereas the population of sub-Saharan Africa is in excess of 1 billion. So it's a key part of the continued economic development of Africa. And also, in particular, Nigeria, that there is additional power generating capacity made available. And also, as well as the actual generation side of the equation, there needs to be greater investment in distribution and transmission. And I'm fully aware that Nigeria has, to a certain extent, tried to address some of these issues through the privatization process, through additional entering into sort of foreign operation and maintenance contracts for TCN, Transmission Company of Nigeria. But I think it's fair to say that there still remains a lot of work to be done in Nigeria and in wider Africa in order to ensure that there is sufficient power available to be able to supply both businesses and major industrials.
Yeah, thank you, Aaron. It's good that you mentioned that there's a lot of work that still needs to be done. And, in light of that, what would you say are the key strengths of a bankable power project?
Well, I think the key strength of a power project, you have to look at it in the sense of foreign investors and lenders who want to deploy capital. What is it that they need to be able to do so? The first is that the price for the power or the tariff for the power is cost reflective. In other words, the amount that they are paid for supplying power is sufficient to cover all of the costs in generating that power. And that includes suitable equity return to the investors, sufficient revenue to be able to pay debt, and to cover all of the costs of generation, operation and maintenance, so on, so forth. In addition to that, the developers and the lenders need to be comfortable that, as well as a cost-reflective tariff, that tariff will actually be paid. Mm-hmm. Now, this is an issue which is a stumbling block in many countries, not just in Africa, but in emerging markets around the world. Essentially, a lot of the utilities are not sufficiently creditworthy or sufficiently investment grade in order to be able to bank a project on a long-term basis. So in those circumstances, there are a couple of solutions. Usually the government needs to provide some kind of support or guarantee. But in addition to that, it's often the case, and it has been in Nigeria with the Azura project, for example, that the World Bank has provided additional support to back the support provided by the government in question. And that World Bank support can be a key element in emerging markets in order to credit enhance and make a project that would otherwise not be bankable into one that can be banked.
Mm-hmm. Yeah. Let's just go further into the transaction documents that you require for a power project, and key one is the power purchase agreement.
Yeah, that's the revenue agreement. So when you're financing a power project, when you're financing the construction of a plant, the debt and the equity invested is going to be paid through the revenues earned under that power purchase agreement.
Yeah, and so deep diving into the power purchase agreement, can you explain to us what are the key obligations that you should see in that agreement like that? What are the risks and how these risks should be allocated to parties? Who should we be allocating risks to, and how should we be thinking about it? When we're drafting an important agreement like that.
So the technical risks relating to the construction and the operation of the plant should remain with the developer because ultimately they've been tasked with constructing and operating a plant to provide power. Now the other key provisions are in relation to how is the tariff structured. Ideally, international investors and lenders would want to see a take or pay or a take and pay, depending on whether it's a thermal or a renewable energy project. In other words, provided the plant is available to generate or available to deliver energy, whether or not the utility is able to actually accept that energy, the developer still needs to get paid. And there are various things that flow off that. Mm-hmm. So there's the treatment of force majeure and political risk. If there are sort of natural force majeure events such as flood and fire, etc., those are typically something that you can seek insurance against, mm-hmm. both for damage and for loss of revenue, so the developer can accept a degree of risk there. But where it's political events such as changes in law or expropriation or other in-country risks, then in those circumstances, the foreign investors would expect the government or the utility to accept those risks.
Right. And do you ever find a situation where a single risk is allocated to both parties as opposed to the parties separately? And what kind of risks would those be?
Well, I mean, if you take change in law, for example, you can split that risk by saying any changes in law below a certain financial threshold should be absorbed by the developer. Mm-hmm. And any changes in law which cause the developer to incur costs in addition of that threshold should be absorbed by the state. So that is an example of where the risks are shared.
Fantastic. Thank you, Arun. You were talking earlier about World Bank guarantees and credit enhancement schemes. What would you say are key steps that project developers can take to de-risk a project in order to ensure that such risks are mitigated or at best, eliminated if possible?
Well, insurance is a key risk. It's key risk mitigant, should I say. And so getting insurance policies that have the coverage that you need to cover damage as well as loss of revenue is important. You can also obtain insurance policies from the World Bank covering certain risks, breach of contract by the government or currency convertibility, etc., which can further help de-risk a project. Other ways of de-risking the project are obviously to have a suitable risk allocation within the relevant project agreements. The selection of a strong EPC contractor and O&M contractor will serve to de-risk the project from a technical perspective. So just from a practical perspective and from a commercial legal perspective, there are a number of different routes and tools that you can use to de-risk a project.
Fantastic. Finally, can you let us know what sort of recommendations that you have for project sponsors, developers in Africa, and African governments in Africa as well, in thinking about a power project?
Well, when you're considering, let's start with the governments, and what the governments need to realize that they are competing for a pool of capital that can be deployed in any number of African countries. So in order to attract that capital, you need to make your environment for investing in the power sector as favorable as possible when compared with your neighbors in the region. And that includes tax incentives, that includes the willingness to provide government guarantees of the utilities, a favorable political risk protection in various project agreements. I mean, that's certainly a key component to attracting that investment. From a developer perspective, as I said, there are two types of developers. There's those that are purely influenced by commercial factors, and there are developers where DFIs are shareholders or have a major controlling interest, and there is more of a development background to that. So increasingly, development finance institutions have been focusing both on the equity and debt side and supporting renewable energy projects rather than more traditional thermal projects, such as they won't, for example, support coal-fired power projects anymore. And even with gas-fired power projects, it's very much viewed as a transition fuel before you can move to more renewable energy sources. But I mean, that's the policy, but from a practical perspective, there is still a huge need for thermal generation in Africa. Indeed, thermal generation accounts for the bulk of power generating capacity around the world, including in developed countries.
Mm-hmm. Fantastic. Thank you very much, Aaron. Thank you for the insightful conversation. We've been able to understand the intricacies in developing a power project, the need for bankable revenue generating agreements, good credit support mechanisms, and the need for government to start thinking about, transitioning from traditional thermal projects to more renewable energy projects. Yes, and that's all for Talking Legal with Templars. See you on the next episode.